A once-in-a-lifetime financial event is upon us as new information emerges to suggest the US government is rapidly running out of buyers for the new debt that they are issuing in order to keep up their ever-growing spending. With the current budget deficit worsening, causing debt to surge at a record-breaking pace, the US government is selling billions of dollars in treasuries to raise this cash and keep up this spending addiction. However, things are changing in the debt market, which means that the demand is just not there anymore to support this supply, which could spell disaster and escalate to a complete debt spiral crisis. Before we go into those details, one key bit of context to mention is that the three major credit companies have now all downgraded the US government's credit rating, or have at least threatened to do so if the situation doesn't improve rapidly. Last week, Moody's cut their US credit rating outlook from stable to negative, citing risks from wider budget deficits and political polarization. Amid higher interest rates, without measures to reduce spending or boost revenue, fiscal deficits will likely remain very large, significantly weakening debt affordability, Moody's did say. William Foster, a senior credit officer at Moody's, also said in an interview, "This is the new environment for rates. Our expectation is that these higher rates and deficits around 6% of GDP for the next several years, and possibly higher, means that debt affordability will continue to pressure the US." This cut in outlook from Moody's comes just 3 months after a fellow Big Three credit company, Fitch Ratings, downgraded the US government in August following the latest debt ceiling battle, while the other Big Three credit company, S&P Global, had already stripped the US of the top credit rating. Now, Moody's does see federal interest payments relative to revenue rising to 26%, up from 9.7% in 2022, with those projections reflecting the likelihood of higher for longer interest rates. In terms of dollar amounts, these debt interest payments now exceed $1 trillion for 2024, and this really is an alarming jump in the portion of tax revenue being spent on interest payments. This means that interest on debt is now the second highest annual expense for the US government behind Social Security, and now exceeds spending on healthcare, Medicare, and national defense. So with faith in the US government's ability to continue paying interest on their debt continuing to drop, the US is now facing the very real prospect of there no longer being enough buyers of US debt in the market to keep buying new bonds that are being issued. And the US government found this out last week when $24 billion worth of 30-year Treasury bonds was auctioned off, usually considered to be the safest duration of bond, but received far less demand from investors compared to what is normal. Now, this did lead to discounts being issued on these bonds to buyers in order to entice them to buy more, allowing them to get an above market rate yield on the bonds, and the yield on 30-year Treasuries on the open market did surge to 4.8% at the time. As a result of this lack of demand for these newly issued bonds, primary dealers such as big banks, who are obligated to finance whatever portion of a Treasury auction isn't purchased by other investors, had to buy nearly 25% of this issuance. Now, this is more than double the amount that they usually have to buy, which on average for the past year has been 12% according to BMO Capital Markets. It is very clear that investors are losing faith in the US government's ability to keep up these interest payments, and concerns are rising about a debt default in the future, which is being reflected in the bond market. If this shortage of buyers for US Treasuries does continue, then it will be a major problem for the US government, who will need to keep offering incentives just like they had to do on this recent offering, such as offering an above market yield for buyers. And if this does stop working, then we could see a situation where the primary buyers, like the big banks, are forced to buy an even higher percentage of the total offering. But if this is not possible, then the US government will not be able to raise the money it needs to keep up their budget deficit spending. Things could very quickly escalate into an uncontrollable debt spiral in which the government has to keep borrowing money at higher interest rates to pay interest on older debt. Another big concern for the US is that countries like China, who are major holders of US Treasuries, have stopped buying Treasuries and have instead started to aggressively sell off their holdings, reducing their overall position in US bonds. So in 2014, China held $1.3 trillion in US Treasuries, but has now cut this position by 40% to about $805 billion after aggressively selling off their holdings for the past couple of years. This now puts their holdings at a 14-year low, and the continued selling pressure coming from China is inevitably at least partially responsible for the rise in long-term US rates. China now being a big seller of US treasuries is a complete contrast to the noughties and the early 2010s, where China had been rapidly buying US treasuries and they were the second biggest foreign investor in US treasuries behind Japan. Now, China is not the only foreign country reducing their treasury holdings though, and we've also seen Saudi Arabia's holdings fall to the lowest level since December of 2016. This is after a rapid sell-off since around February of 2020, where Saudi Arabia's treasury holdings have fallen from $184 billion to now being $108 billion as of June 2023. Now, this pattern of major foreign holders of US treasuries selling off their holdings is a very concerning one and is likely to continue due to the current economic circumstances in the US. This additional supply being offloaded onto the market alongside all the new debt that the US is issuing themselves is clearly too much to meet the demand and is leading to continued downwards pressure on bond prices, leading to rising yields. With no buyers left in the market to keep buying new government debt being issued, the only options left are to drastically cut spending or to raise taxes, both of which would have harmful effects on the US population. We know that the stimulus check money has all but dried out at this point, and that US consumers are really starting to struggle at the moment. After a brief period of growth, the personal savings rate is now back down to being close to rock bottom, with the average person in the US now saving just 3.4% of their income, which is about half of that seen in 2019 pre-pandemic. And many consumers are turning to credit cards to continue their spending addictions, as we can see from this recent surge in consumer credit card debt since 2021, which is now for the first time ever in history above $1 trillion. And with interest rates on this credit card debt also at new highs, the combination of high debt and high costs on this debt almost mirrors that of the US government and means that many consumers are currently in crippling levels of debt. Of course, one other alternative that could be turned to as a get-out-of-jail card would be to simply print more new money. This, however, would of course be very harmful to everyone across the economy and would lead to a sharp rise in inflation once again. And high inflation is of course the main reason for the surge in interest rates and bond yields that we have seen for the last year or so, meaning that simply printing new money would keep the US government stuck in a never-ending cycle. It is expected by many that interest rates will remain higher for longer in order to truly get inflation under control, and Jerome Powell has come out and reinforced this by saying that the Fed may not be done raising rates just yet, and that they need to wait for more evidence that inflation is cooling. He does say that the central bank was not confident that it had raised rates high enough to lower inflation to its 2% goal in the next 2 to 3 years, and we're trying to make a judgment at this point whether we need to do more. However, just the other day, on Tuesday, we did have the new CPI reading come in slightly below expectations at 3.2% year over year compared to the expected 3.3%, which was encouraging to see. Inflation falling faster than expected is no doubt a good thing. However, this rate is still well above the 2% target, and it is still expected that interest rates will remain elevated for some time. Only time will tell how the US government gets out of this ever-growing debt hole that they are digging for themselves. However, with the appetite for US debt drying up and no new buyers coming in to help, they are certainly in a very tricky situation. High interest rates are also causing major problems in the banking sector, and we have started to see a new wave of banks collapsing, which could trigger a second banking crisis this year. I go into more detail on this in my previous video, which you can check out on the screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.